Hi everyone, I am Safi and I am here to discuss about organizational financial practices. Let's start. Introduction. However good the quality of its products or services, no organization can be successful for any length of time unless its finances are soundly managed. Many young software engineers are attracted by the idea of starting their own company. A group of new or recent graduates in computing decide to set up their own company to provide software services, and their intention is typically to offer contracts hire services. A client is unlikely to pay an invoice within less than 1 month of receiving it. Some large companies are notorious for not paying invoices for as such as 6 or even 12 months. There will be a need to have some money within which to start the venture. The group needs enough cash in hand to be able to live for at least 3 months. Additional money will be needed for the expenses of starting the company. For large projects or packages, a much larger sum of money is likely to be needed while they are being developed because there will be no revenue coming into the company. For starting period, cash will be needed for salaries, rent rates, heating and lighting of the premises used, equipment and consumables, costs of advertising and marketing the products, miscellaneous expenses ranging from company stationery to traveling expenses. How does one set about this money, raising this money? The first step is to produce a business plan. It typically contains a description of what the company will be doing, together with information to show that it is technically feasible and that founders of the company have the necessary expertise, an assessment of the size of the market and the competition, a prediction of the financial performance of the company. What are the sources of funds? The sources of funds can be grouped into grants, loans, sales of equity. What are the sources of funds? Grants, loans, sale of equity. This is important for short question in exams. What is grants? A grant is a sum of money given to the company while the company is obliged to demonstrate that it has been used for the purpose for which it was intended. It is not intended that the grant should ever be paid back to the organization which gave it. The availability of grants and other help for new companies depend very much on where the company is located, how many people it expects to employ, and on government policy at the time. What are loans? A loan is a sum of money lent to the company, interest in payable on it at a rate that may be fixed or variable, and the loan is usually for a fixed period. The company is liable to pay back to the loan, and if the company goes into liquidation, the lender is entitled to recover the loan from the sale of the assets of the company. In most cases, security is required for the loan. What is what is sale of equity? Equity capital is money paid to the company in exchange for a share in the ownership of the company. Shareholders are at much greater risk of getting a poor return on the capital or even losing it completely than our lenders, but in compensation for this, they stand to make a greater profit than lenders if all goes well. Budgeting and monitoring. A budget is a prediction of the future financial position of an organization covering usually the current or the next financial year. The ordinary manager is a company is however much more concerned with budgeting for income and expenditure. Budgeting is an iterative process. The first version of the budget is likely to show expenditure exceeding income since the operating manager will want to expand their operation while the sales and marketing departments will not wish to give hostage to fortune by being over optimistic about the volumes of sales it can generate. Adjustments will have to be made repeatedly until a situation is reached in which budgeted sales exceed budgeted expenditure with a reasonable profit margin. The operational managers are happy that they can service the predicted volumes of sales with the budgeted staff levels, and the salesmen are confident and they can produce the predicted sales. Working capital and cash flow. This is also important for the short question exams. It's perfectly possible for a company to be consistently profitable and yet be unable to pay its bills. Accounting normally operates on an accrual basis. The value of work is in progress. It is usual to negotiate stage payments rather than leaving all payment until the work is completed. Cash has therefore to be found to cover the gap between what a company has to pay out in cash, what it receives in cash working capital. A document cash flow prediction is the amount of cash expected to be received and disturbed in each of the next 12 months. The bank specifies the maximum that can be borrowed on an overdraft, but interest is only payable on the amount actually owed. Thank you very much, guys.